Good afternoon, everyone, and welcome to the Pierce Atwood webinar on the Inflation Reduction Act of 2022, 1 year later, or as we sometimes say, the day after. My name is Merrill Kramer. I am a project development and finance partner at the law firm of Pierce Atwood in the Washington, D.C. office. I will be acting as moderator today. Joining me on this panel this afternoon are Karen Berry. Karen is the managing director of NT Solar. NT Solar is a national tax investment and advisory firm. Karen directs the company's team in originating, structuring, and underwriting energy tax credit investments. Karen is joining us via audio. Also joining us is Jesse Robbins, principal of structured finance at Generate Capital. Generate Capital is a leading sustainable infrastructure platform in the U.S. Jesse leads tax equity and other capital formation efforts in the capital markets group at Generate Capital. Welcome, Jesse. And finally, Chris Emick is my tax partner at Pierce Atwood, resident in the Portland, Maine office. Chris is also co-chair of the firm's energy infrastructure and finance practice. Karen, Jesse, and Chris, welcome.
Thanks for having us.
Thanks, Merrill.
Before we start our discussion, for the audience, please note that we do plan to take questions, but you will be on mute. So to facilitate Q&A, there should be an icon on your Zoom screen marked Q&A, which is logical. During the course of the webinar, please feel free to post a question. We will try to answer questions during the webinar, but we plan to reserve the final 15-20 minutes at the end of the hour where we will try to answer as many of your questions as we can. The webinar will last 1 hour. It is being recorded and we will be reposting it later for rebroadcast. Okay, so let's turn today's topic to the Inflation Reduction Act 1 year later. I'd like to start out by going around and asking our panelists the same question. It's been a little more than a year since the IRA was enacted. The IRA was intended to stimulate investment in the clean energy markets, including in specific types of technologies. Starting with Karen Berry from NT Solar. Karen, what would you say have been the most significant changes that you've seen in the clean energy markets over this past year?
I think for new technologies like green hydrogen, renewable natural gas, standalone battery storage, and manufacturing, we hope, have been the areas that have moved more quickly into benefit or looking for benefit from the IRA. The transfer credits are a hot market in some ways, but not for every segment of the market. I think that there's still a lot of waiting and watching to see how the portal works, both for registering for transfer credits and then getting a number from the IRS once it places in service that is the main CP for payment of transfer credits. And for middle market deals, which I would describe as 5 to 75 million in credits, who will almost always have more value in the deal than just build cost. So we'll be looking for it to pass through another structure or some way of getting reasonable evidence of eligible basis before they sign up for transfers. And in all cases, the transfers are not as good a deal either for the investor or for the developer. I know a lot of people thought that getting rid of transaction costs would just be the most wonderful thing, but you don't get rid of transaction costs. So I think that new technologies, great. Transfers, movement, and the rest of it is still a bit of a waiting game.
Okay, well, we are going to spend a little more time on transferability and how it's working or not working a little later in the webinar. But let me turn to Jesse and ask you the same question. Jesse, you recently closed your last fund. How has the market changed? How have your types of investments changed?
I would agree with Karen's very succinct summary there. I think the biggest success story or area of activity for Generate as a sustainable infrastructure investor across power, but also wastewater, agriculture, and mobility would have to be new technologies. We're very active in front of the meter storage, which prior to the IRA did not receive a standalone credit. We're active in electric vehicle technology, and we're active in various microgrid investments as well. So there's a lot of opportunity there. Renewable natural gas has seen, a huge boost from the IRA. It's not without its questions. For anyone following the recent Section 48 regs that were released, there's a lot of changes there, or a couple surprises. Specifically for renewable natural gas and certain equipment that may not qualify. So there's certainly some mountains still to climb, but at least for Generate, we've done a few deals this year that were standalone storage, and we've done other deals that take advantage of either adders or different technologies that were not previously eligible that are already in practice. The adders themselves, I think, it's more of a mixed bag. We've seen a lot of success around energy communities. Initial guidance came out relatively early. It was relatively clear, as always, on a relative basis here. And there's enough certainty there that we're actually seeing it spur development in certain communities that qualify under the energy community adder, areas that had, high fossil fuel employment, for instance, or closed coal plants. Generally creates a very clear fact pattern that you can plan around for multiple years of development. The domestic content adder, we were successful in closing a fund that underwrote and funded on the domestic content adder, which is, I believe, one of the first in the market. But it is a challenge. It's dependent on the technology. Certain technologies and manufacturers create an easier fact pattern to underwrite than others. Folks that are complaining about the complexity of that guidance, I think, are right to do so. And then finally, the low to moderate income adder, we've submitted for a number of applications, mainly community solar, some rooftop solar as well. They would take advantage of the different categories within that adder, but no awards have been made yet. And unfortunately, we'll be well over 18 months out from the IRA, I think, before that program really starts to come to fruition. And it's an open question of how much benefit will actually make its way into those communities.
Okay, I'll have to turn off my.
You're not available for questions right now.
Yeah. Someone's trying me on all my devices. I'll have to hold your questions, as I said. Okay, well, that was a good summary. It sounds like there's some big winners. It sounds like storage, microgrid, which had been pretty dormant, EV charging, RNG. Chris, what have you been seeing? What are your observations on what's happened in the clean energy market over the past year? What kind of technologies are you seeing being boosted? And generally, is the IRA having its intended effect here?
Yeah, so what's interesting to me is that, I think there are different views when the IRA passed, this is a revolution. To me, it's been more an iterative change in at least my practice and in what we're seeing here at Pierce Atwood. Certainly things have changed. I think that the focus on storage is probably the most significant change that I've seen. And that may be a result that certainly the standalone storage credit is a significant part of that. State incentives are a significant part of that as well, trying to boost storage to deal with, grid issues. The other changes that I've seen is that, a lot of projects that may have been, tougher to pencil out, when the credit was reduced either with a reduced PTC or reduced ITC, became much more viable when the credit got increased to 30% and maybe even to 40 if you're an energy community, et cetera. And same on the PTC side, and that the increased credit really had a positive impact in a world of increasing interest rates. So that was impacting projects negatively, and the credit really balanced that out. So that might have the increasing interest rates at the same time may have moderated, a positive impact from increased credits. The other big change we see is, not energy production, but, manufacturing. The 48C advanced manufacturing credit, have a lot of clients with interest in that, looking to build projects. That to me, that's the boost to domestic manufacturing, I think, was really a big aspect of the IRA. And that's not a change that's going to happen overnight. And that's a change that, building new manufacturing plants is a, 1 to 7 year process. But really, there's been a lot of interest in that. And, to the extent that the IRA was, designed to boost domestic, to be a job creator, really, that's a big aspect of that. And, that's a little bit of a TBD still.
Yeah, I've similarly seen a lot of activity on new manufacturing in response to the credits available under Section 48. Karen, Jesse, do you agree with Chris? And I would add, there are a couple of technologies that were provided new stimuli that no one's mentioned. Maybe zero nuclear power, zero emission power. What about that? What about you mentioned green hydrogen? Is that getting traction? CCR, carbon dioxide sequestration, carbon capture. How are those technologies responding to the IRA? Let's start with Jesse.
Sure. Yeah, I suppose first of all, would agree with Chris, and should have mentioned some of the exciting activity around manufacturing, which is both spurred on by a credit for manufacturing, advanced manufacturing, but also activity around onshoring manufacturing because of domestic content incentives. So there's a whole, world of, alignment around investing in manufacturing. Generate has looked at those investments. We haven't transacted to date. But even the fact we've looked at that space, I think, is indicative of how much momentum is there. We're traditionally, Karen and I in our world's focused on deployment and operating assets, producing energy. So you mentioned green hydrogen. You mentioned carbon capture. We're looking at both. We've invested in a green hydrogen developer, and we'll be bringing projects to market over the next couple of years. Again, questions remain. I think there's some guidance being discussed and it's forthcoming around additionality and 24/7 matching of green hydrogen, and really defining how or clarifying how tightly that will be defined, which will affect the addressable market for that technology. Carbon capture is something we were looking at prior to the IRA as well. With a sustainability focus and being a public benefit corporation, we would only look at a carbon capture pathway that was truly carbon negative. So that would be probably limited at this point for large scale commercialization to long-term geologic sequestration. And those opportunities are just limited, and they're typically very large ticket sizes. So I think that the big story with carbon capture is the potential it can have on the tax equity market, which I know we'll get to. Don't want to jump ahead too far, but there are some very large deals that have and will continue to come to market with tax equity needs or tax capacity needs in the billions, some of which can be handled through direct pay, but not all. Karen, curious if you've seen any of those deals or potentially dipped a toe in the water.
Well, we looked at the carbon capture stuff, but as you say, being a company that's focused on community benefit, most of the carbon capture deals that are out there are for enhanced oil recovery. Hard to wrap your arms around that as something that's really beneficial to the environment or to local communities. So we just have passed on those opportunities. I don't know about the big things that take carbon out of the air. Those are kind of interesting, but I don't think they're really game changers. Back to an earlier question about the adders and which ones are easier to use than others. Well, yes, the energy community one is very clear. Thank you, IRS, for making one of these very clear. It's an easy one to use. And domestic content, hopefully we'll get some better guidance on that. I mean, going all the way through to the initial screw that puts it all, that starts the process is too much. And the LMI adder, if they were really serious about wanting to help low moderate income communities, why is there a cap on the amount that can be supported? Not really sure. And it's still confusing as to whether or not it could get it to a 60, is it a 10% or a 20% credit? I think that's not altogether clear. But the better way to go would have been to do it through the state programs that have been really successful in moving LMI investments. I don't know why they didn't do that, but we'll wait to see. I'll wait with some hope that that program will work too. On the other hand, having the adders add to the tax credit availability in these deals doesn't necessarily have what people thought was the logical outcome. And unless there's a lot more tax equity looking for the deals that would get those adders, all you're doing is doing fewer deals for the same amount of tax credits. And going from getting a 10% adder can, in effect, because of the weird ripple way that some accountants are doing the appraisals, could actually double the amount of credits in a deal. A 10% adder takes a $50 million credit deal to a $100 million credit deal. And that's a lot to swallow if you're the investor that's in that. So I think that is a challenge for the appraisal companies that are looking at how to realistically and thoughtfully appraise an adder in the value of the deal.
Karen, before we leave to that point, can you explain that? I think a little more simplistically for our audience. How does so you get a 30% let's say base credit, and then you have a 10% adder. How, in the way that 10% adder is being valued, how does that double the amount of tax equity out there?
Well, it's almost inexplicable because it doesn't make sense, but that's how it works. You add in the value of the extra credit is now income to the project. So it's and as well as the fact that now the losses available are 20% of the available credit instead of 15, and that adds value to it, and it doubles.
It's circular. Yeah, the income approach in the appraised value, if you're not somehow limiting or averaging or otherwise capping the income approach, it becomes circular. I don't think we've seen quite 10% doubling, but certainly for community solar projects that could potentially qualify for the 20% LMI adder, the effect is staggering. It makes it very difficult to plan for your capital needs.
So it will eventually price out debt, especially since debt is expensive right now and tax equity is not that expensive. Tax equity, the pref rates are somewhere between 2 and 3, maybe 3.5. That's in effect the interest rate you're paying on the investment, and the federal government is paying the principal. So that's the debt providers don't like to hear that, but that's the reality. And then it becomes whether or not your tax equity investor has the appetite to go higher.
Okay. Well, it sounds like, at least when people are going to do the numbers together, they're going to realize the incremental value of these bonuses, or at least for those projects that are lucky enough to get the tax equity. But you're leaning into another topic, so let's just go straight to that, which is which I think people listening would be very interested in. How is this all affecting the availability of tax equity in the market, and how is it affecting pricing in the market? Karen, let's stick with you. What are you seeing?
I think tax equity pricing is going to come down for higher returns for tax equity because there is less of it and there's more tax credits in the individual deals. I think the transfer market is bringing in new investors for sure, corporates mainly, who are saying things like, yeah, I'll take 100 million, I'll take 200 million, sign me up. Can we close in a week? What do I need? 1.5 pages worth of contract? And maybe it sort of works that way, but that sounds like dumb money to me because there are some risks, even still, even with transfer credit. I think the main bonus for transfer credits is what it looks like on GAAP books, which has always been a major barrier to market entry, the fair value, HLBV, impairment, all that kind of stuff. So maybe, and I know that there are these trading platforms out there, Crux being the main one. I don't know that it's really that simple. I still think, you may just be buying a credit, but you're still at risk and have some liability for the 5-year compliance period. You ought to look at that, big guys. So I think it would be a terrible thing if somebody bought a low doc, quick doc transfer credit, and then something went wrong and it spoiled the market. It soured the market on transfer credits. So remains to be seen. Well, hey, it's the Wild West out there. We're all trying to be thoughtful and have some integrity about the things we recommend.
Well, okay, well, as long as we're talking about transferability and how it compares in the market,
Meryl, maybe before we move on to that, I think it'd be good to get Jesse's thoughts on pricing and availability as well.
Oh,
Yes, I was going to say about pricing. I think tax equity prices are going to drop from somewhere south of $1.20 per credit to south of $1.10 per credit. And on transfers, they're running between what you, Chris, said on our previous call, between 85 and upper one I've seen is 92. Jesse has more experience.
It's important to clarify that Karen's quoting pricing on a time-based flip. On
Yes.
yield-based flip, I think there's two stories here when you're talking about tax equity. There's pricing and then there's availability. And on the yield-based flip, we saw yields move upwards prior to and around the time of the IRA passage, almost as a result or due to interest rate and cost of capital pressure. And they've continued to inch up just due to supply and demand. But the way the large, call it 6 providers, yield-based flip providers in the market that comprise maybe half the tax equity market, the way they think about this, it's not an elastic market. It's relatively inelastic, and it'll satisfy the demand that's there, and then it's a finite amount of capacity, and it's gone. And it's typically done in conjunction with broader client relationships at those large institutions. Separately, there's the time-based flip market, which tends to be more the syndicated corporate or more regional bank market. And that is a little bit more elastic to an extent. So pricing is adjusting there. And we're seeing those investors who typically think about their deals in terms of a return on investment get better pricing, get better returns in the market. But again, they're getting more overall benefit out of the deal, but they're 40% or less of the capital stack. I think the bigger impact to sponsors is just availability and certainty. So that's what we're focused on is finding those relationships that want to do deals year over year. And what's exciting about that space is the additional capacity that transferability can create. So we'll go into the transferability world. There's so much we can say there. But I think that both for the yield-based flip and the time-based flip providers in different ways, we'll use transferability through structured investments. So not standalone or pure vanilla transferability where you're just selling credits out of an unstructured deal, but you actually have a partnership of some sort and credits are being sold or third-party buyers coming in to create that additional tax capacity.
Right, like a hybrid. You have the regular partnership flip, and then the tax equity owner sells their credits. Yep. They keep the losses. And having had a partnership flip established with the holdco is good evidence that you have met the basis requarements.
Yeah. And I guess I should put some numbers around pricing. That was one thing I neglected to do.
I was about to ask you. But yeah,
I conveniently forgot that. So we think about our time-based flip pricing in terms of the return on investment target that investors are seeking. Prior to the IRA, the more competitive end of the market was maybe a 115 ROI to 118 plus. If you are working with a technology that's not solar, and you're going a little bit off the beaten pathway, maybe you were seeing 118 to 120 prior to the IRA. we're really seeing that shift, maybe more up to 117, 118 on the lower end, all the way up to, we're seeing some bold asks out there in the market, maybe a 1.2 all the way up to a 1.25 plus. And it's because there are technologies and there are deals out there where the alternative would be a simple transfer structure. So an investor that's coming in, that's able to monetize depreciation and able to create a partnership that would justify a arm's length fair market value, creates additional value, and they're taking advantage of that. Those providers are taking advantage of that. And then on the yield-based flip side, I think prior to the IRA, from big utility scale solar all the way up to distributed or community deals, maybe it was a range of 6 to 8.5%. And we're seeing that shift up into the nines. I don't think we've quite crossed the double-digit threshold on the upper end, but I wouldn't be surprised if there are deals happening around the margins there.
Yeah,
Karen,
I totally agree with you. Yeah,
you want to
but
backtrack me on the time-based flip pricing?
yeah, I think it has been between 16 and 18, and it's going to move to 18 to 20. And I think return for the investor, and I think on the larger utility deals, that's going to be, you won't be able to get that. Those deals are too skinny. There's not a lot of margin in them. So it might get up to 10%, like you say, double digit, but that's a hard sell.
So what, can you explain, it sounds like that's quite a degree of magnitude between the value of tax equity in a traditional flip structure versus in transferability. It sounds like it could be a 35, 40 basis point flip. Why is that? Why are we seeing that kind of a difference in the market?
Well, for one thing, buyers of transfer credits aren't getting the value of losses or an exit value or cash. So there's no reason for them to make the kinds of returns that they make when you're actually in an equity position in the asset. So, but the new players, the new entrants that are coming into the market don't have the same kind of financed transaction expectations of return. I think there's more resistance to transfers on the part of the developers who are not getting help with monetizing the losses, and maybe they get more cash and they don't have to exit anywhere, but it still doesn't really balance out, again, for what I said before, that tax equity in a financed transaction is getting somewhere around 3% interest on their money, and the federal government is repaying the principal. And when they exit, it's somewhere south of 10% of the original capital contribution of the investor. So that is still a more robust financial deal for the developers than a transfer.
Karen hit the nail on the head on that one.
Yeah, I think it's a common misconception. Folks hear a lot of discussion around transferability and assume that it must be taking off because it's accretive. It is not accretive, but it is available. Those are two different things.
Can we just step back a second? Chris, I'm just going to ask you to explain what transferability is, and also elective pay, since we're going to be talking about that as well. What is it, and how do those work?
Yeah, happy to. So yeah, we've been talking about, we said probably the word transferability a couple 100 times so far on this call. We haven't talked about what it means. So the IRA created two new ways of monetizing all of these tax credits. So solar ITC, wind PTC, and a bunch of other tax credits as well. The typical market was doing tax equity transactions, most of which were a partnership flip or a sale leaseback or an inverted lease. And all of these were complicated transactions people have been doing for decades. Most people in the industry knew what it was. Transferability and direct pay sort of upended that market by creating what are, in theory, I think, and in practice, are simpler transactions. Because, for direct pay, that's available to 501c3 organizations, tax-exempt organizations, which include sort of local governments, Indian tribes, very Tennessee Valley Authority, organizations like that, which can now simply receive a check from the Treasury for their credit. So, I'm a 501c3 as an example. I put a solar system on my roof. It cost $1 million. I'm entitled to a $300,000 check from the federal government as a result. Pretty simple, pretty straightforward. You know, it's limited, but it is a check there as opposed to doing a much more complicated transaction, especially in the case of tax exempt organizations, which can't be an owner of the system because of the tax exempt use property rules. You know, stuff only the tax geeks like me care about or are interested in, I should say. So that's direct pay. It is what it is. It's a check from the government. Transferability is available to all organizations that aren't eligible for direct pay. And what that is in theory, it is a sale of tax credits. It is what me as a tax lawyer, I am always telling my clients, and typically those, don't say we are selling tax credits. You are not selling tax credits because the IRS doesn't like that. That's the old world, right? You couldn't sell tax credits. Rather, you had to bring in an equity investor. They had to be a partner in a partnership and meet all sorts of standards that were complicated. And people like me, you know, did well giving tax opinions on structures like that. In this new world, you can sell tax credits, but you're not. The person coming in is not an equity investor. They don't get the depreciation that the equity investors do get. And so that's what Karen was talking about. Why transferability is lower pricing is because they don't get that other tax benefit, being depreciation related losses. And they don't get the other cash returns that an equity investor would get. It really is a sale of a tax credit, piece of paper, a contract, and that could in theory be done as simply as, you know, a contract with a couple of pages. As Karen said, that's not what anybody's going to recommend, but in theory, that could be done that way.
So,
Explanation.
yeah, that was great. Thank you. Well, it raises the question, given the earlier spreads, and now we understand why there are those spreads. So if you're talking about a middle market or a distributed generation facility, maybe it doesn't have the same kind of tax equity. You know, the big money center players are not going to look at their projects the way they would look at larger portfolios. So they go into this transfer portal, they sell their tax credits, but they get to keep the depreciation and the losses and the income from the project. Just put you on the spot, Karen or Jesse, have any of you done an analysis of how badly or how do the returns to the smaller developer compare by doing that versus going through the whole partnership flip kind of transaction?
So if you're talking about a smaller developer, you've complicated the analysis even further because it's already complicated enough. You have the variable of what the price per credit is on the credit you'd be transferring in your transfer scenario. You have your alternative tax equity investment pricing. You know, what is your alternative structured option if you have one, assuming you have one. And then the third variable here is if we are talking about smaller transactions, transaction costs do become meaningful. Karen will then point out that even in a transfer, there's still diligence and there's still underwriting and documentation that has to happen. But from what we've seen, at least, it is a bit of a lighter lift and a less expensive lift. It's difficult to generalize because it is so project specific and unique to each and every deal that, as we all know, each one is a special snowflake.
Well, so let me just ask it this way. So on an apples to apples basis, you know, same project, looking at one versus the other, it sounds like you're saying, putting the transaction costs aside, and I know we can't, and maybe us lawyers don't want to, but from an economic standpoint, it sounds like you're saying that there's enough of a premium associated with getting the whole package that a partnership flip would be a better deal for the sponsor than going through the transferability portal.
Correct. That's what we've seen. The break-even point would come, and again, this is based on transferable pricing, which Karen mentioned it earlier, but 88 cents to 92 cents is probably where the middle 50% of the market is currently. in that range, there is a break-even point, probably at the very upper end of maybe the time-based flip market. So the least attractive time-based flip pricing from the perspective of the sponsor, at some point it is, you're just as well off to go the hybrid transfer route.
Yep.
To me, the big question in terms of the big variable in terms of transferability versus the traditional structure, if you're that smaller developer, is your ability to use those losses. Are those losses going to essentially just be suspended for 10 or 20 years, in which case there's no value? But if you are, net positive on other projects, on other assets, and you can use those depreciation benefits, my guess, and I haven't run the math, is that the transferability works out better for you than it otherwise would.
Yeah, it narrows that band. Yeah, for sure.
Yeah, but you have to be able to do, this is one area where middle market deals would have a bit of a benefit in that they can do 2 or 3 or 4 or a whole portfolio of deals in 1 year and finance some with transfers and others with financed transactions, and then balance the losses you have from the financed transaction, from the transfers with your financed transactions. So, and that's a game that US Bank plays very well. They always consider where their loss on exit, gain on exit, where they're going to have depreciable losses they can count and where they will not. So that is an investor calculation that we help investors with as well.
Karen, on that kind of structure where you go to say a USB and the project gets sold into or put into a holdco, and then USB is I think, if I'm understanding you correctly, then goes into the transfer market to sell the tax credits. What does that do to the transaction costs for a sponsor developer? Are they having to effectively pay for 2 different transactions there, as opposed to going?
No, not really. That's the benefit of having somebody like a US Bank in the middle. They will have to allow for the credits to be listed as transferable in the operating agreement or LLCA documents. But after that, it's really up to US Bank to do their own diligence on who the investor is, and share with them the documents that they got. For example, an independent engineering report and an appraisal. It depends on whether or not this new syndicated investor has other demands that the diligence process of the first transaction didn't cover.
So I think it's worthwhile to sort of explain the transaction structure that Karen's talking about there. What she's talking about is a traditional partnership flip in a way, but the investor carries the ability to transfer that credit, so that the tax holdco essentially sells off the credit through the transferability regime and keeps the depreciation. So essentially the initial tax equity investor keeps the depreciation, and the secondary tax equity investor takes the credit through the transfer portal, which is a pretty neat structure when you think about it.
Right. And not only do they keep the depreciation, they also keep cash from the deal, which is accelerated at exit. So it's depending on what their need is for the value of losses or their lack of tax appetite for the actual credits. It's a way of managing both of those things. Plus, if you've got an adder in it, like a 40% tax credit, that makes it more worthwhile for the developer not to care if it's being transferred after they sell it into the original partnership. And same thing for the original tax equity holder.
Yeah, it's neat. It's a slicing and dicing of benefits, almost like a coupon stripping type of thing that you might see in on Wall Street.
Right.
The difficult part to me on the sponsor side is it increases your counterparties.
Yeah.
What we are, and we're able to manage that, but I especially think for the less established sponsors and smaller deals, smaller into the market, that is a challenge. I am waiting and seeing some activity around the investor side, figuring out how to put that together in an efficient package. I think it's being done, maybe not with the most efficient structures, most efficient players. But Karen, curious if you're thinking about how to offer that as a prepackaged product to your clients.
Why, yes, we are. It helps to have somebody like us.
Yeah.
Somebody like that. Thank you, Jesse, for the free ad space. But I think that developers that are used to seeing investments come in through multi-party funds, this will seem somewhat familiar to, but in all of these cases, you have to have agreed to one manager of the tax equity. We do that if we put together aggregator funds. We are the manager and we get all parties to agree. All questions come through us. All responses come through us. Let us do what we know how to do. You go off and do what you're good at, which is not this. With something like an experienced bank in the middle, they will insist on being the manager. But still, you do have more counterparties. You're right, Jesse.
Do you have one set of lawyers? Is my next question. That's
Yeah.
real interesting.
Yes, and problematic because, oh my God, I'm not okay. So Pierce Atwood, close your ears or something. But man, they come in at the last minute when they've just been hired by lenders or something, and they want to change all the terms and insist on not actually any
Substantive
material changes. They just want to brand it as their own. So they want to change all the places it says happy to say glad. And it's so annoying.
Well, I like to say that we don't have to cover our ears. We don't do that at Pierce Atwood, but
Okay,
we
good.
certainly deal with other lawyers who do that to us fairly often.
Listen, before we leave pricing, let's look forward for a second based upon what you've seen and, based on the queue, the pipeline going forward. How do you see tax equity pricing looking in the, say in 24, 25? Who do you see as being the players? Are they going to increase? What does the market look like from a pricing standpoint? And is it different for different sectors, technologies, et cetera?
I think you can get 18 to 20% rates of return on middle market deals because they're selling power into the retail market, not the wholesale market, and they're getting somewhere around 20 cents per kilowatt hour. Whereas in the large deals, they're selling into the wholesale market and they're getting sub 5 cents a kilowatt hour. That just leaves a lot more margin on those middle market deals. But I will also say there are other things that are driving pricing in addition to the IRA, and those things are like proportional amortization, Basel III. I think a lot of the tax equity investor market is going to move to corporates and stop it and balance out more evenly the big banks. And Jesse, you mentioned earlier that the big banks who do the yield-based flips, a lot of those have run out of tax capacity and have said they're closed for 2024. Maybe they can talk to you about 2025. So that's leaving a lane for corporates and more insurance companies to come into.
To complete that picture, 2025 is the earliest the Basel III regs could take effect, though it's likely to be delayed. So I haven't heard the larger banks knocking down folks' doors to offer commitments into 25, though I'm sure they have some. And the other piece of that picture is the banks are also standing up syndicated desks to sell transferred credits to create additional capacity for themselves to then place through a structured product. It's just happening much more slowly than on the non-bank, non-institutional side of the market that is more the, syndicated or kind of corporate side. So I think the question, if you go back to the question of what pricing will look like into next year, I think you have to start from capacity, and I'm very encouraged by what we've seen on corporate activity for large buyers coming into the transferable market. I think that's a great and very needed sign. If we can continue to see that happen in a big way, I'm encouraged that pricing will stabilize. Though I do think across technologies, you will see some differences. If the appetite from corporates is there, I think the supply demand will continue to balance somewhere around the 88 to 92 band. with some, going off of that band for very strong deals, deals that can align well with quarterly estimated tax payments and certain corporate fiscal year ends. The timing of when that credit can actually be monetized by the corporate versus when the corporate has to pay for it is a very important dynamic to understand if you're selling credits. And then the lower end of the market, if you're working with a deal where there's not a strong sponsor guarantee, you're not able to procure ITC insurance, or you're dealing with a off the beaten fairway technology, you might be on the lower end of that. And then for traditional tax equity, that's, I think, the most difficult to predict, because there's the supply demand and the transferable structure element as well. Even what may have looked like traditional tax equity from some of your providers, unbeknownst to sponsors, there may be credits being sold off the back end. And so how is that going to affect, the traditional terms that folks are able to offer?
Right. One just little digression aside from that, we talked earlier about basis for transfers and for other things. And when there are IRA adders, how in the hell does that double the amount of credits? It is a challenge for appraisers, and we've seen insurance companies stepping into that and saying that they will not go with the income approach to valuation solely. They want to see it balanced out with cost income hybrids. And it would be great if you were going to do a transfer deal with somebody where the sponsor has deeper pockets than any insurance company you can think of.
And so the Basel III requirements, which increase the capital requirements on banks and are therefore not directly applicable to corporates. Do you, just following up, Jesse or Karen, do you see corporates gravitating toward transferability because of its simplicity, or do you think they could rise to the level that they could be a full, the full tax equity with the depreciation? They could take the traditional tax equity role.
We're seeing more activity around the former. Corporates gravitating to transferability, both corporates that are new to the ITC space entirely and are just attracted by the simplicity that transferability offers in terms of balancing their tax exposure. Every CFO in America, I'm sure, is looking at this, or will need to if they're interested in keeping their jobs. We're actually seeing kind of the opposite of corporates becoming traditional investors. If there are corporates who are traditional tax equity investors who are saying, why do I need to go through the headache of doing a partnership flip or an inverted lease? Taking operating exposure for 5 years, waiting around to get some of my return in the exit, dealing with the accounting treatment, often very burdensome or unattractive, on and on. And the internal, administration cost of those investments, and actually choosing to go the transferability route, even though the return isn't as attractive. Alternatively, there are corporates that want to be equity owners in energy transition projects. They want the environmental attributes, or they want the, involvement in those projects. And there are other strategic reasons for them to be involved as well. I think it depends on what the core business of the corporate is and what their goals are. But I would say it's more common that they would go the transferability route, just all else being equal.
Yeah, the corporates that have been doing finance transactions are more likely to stay in finance transactions if they get the environmental attributes along with their investment and they like the returns. And, that's I would say the big, huge corporates are more transfer oriented. And then the mid-size, again, we want the return, we want the environmental attributes. So it's not a homogeneous group of players.
Okay, so TBD. If for our audience, if you do have any questions, we're nearing the end of the hour. Please feel free to post them in the Q&A window, the portal on your screen. Hopefully, it's somewhere on there. Let me ask you this: in terms of transferability, in terms of corporates playing a bigger role, do we see is the market gravitating, or are players gravitating for or against certain of the additional bonus adders? Does that settle? Does that make it more difficult for people to play in the transfer market? Is the market becoming bifurcated where people, or specialized where people understand, say, a brownfield adder or a low income adder, or want to play in that market, or people just like the 30% ITC because they've done it before and they understand it? Let's start with Chris. Are you seeing any? I know you're doing a transferability deal. Do you see any differentiation between the base credits and the bonus credits?
I haven't worked on a transferability deal that has had bonus credits yet, so I don't know that I can speak to that piece of it. In terms of the bonus credits generally, I think as Karen mentioned earlier, the brownfields adder, the energy community adder, really is the one that we've seen some significant activity around, in part because it's a sort of static determination, and a reasonably easy determination to make, as opposed to domestic content, which is the other really significant adder, where there's challenges there, and there's documentation and there's documentation challenges around that, which then creates additional risk.
And I think it's worth noting, maybe Chris, you could talk a little bit about, there's a interesting part of the regs around not being allowed to transfer purely the credits from an adder, which I think is such a fascinating stipulation, because you're otherwise allowed to slice and dice credits. You can sell 25% of your credits and keep the rest, so on and so forth. Who's to say really which the credits are fungible, right? Which credits are from the adder. But I think that's an interesting thing to note in this conversation, where technically, this idea that you could then you could have your traditional tax equity investor take the 30%, and if you got an adder, if you qualified, you could then go on to sell the rest, is technically not permitted.
Yeah, that's exactly right. You sort of have to look at the credit as a whole, as opposed to a separate credit for the bonus.
Although hopefully by the time it places in service, you get your registration number from Treasury, you know how much your credits are going to be. And if I think you can still list it as a percentage, right? We want to sell 50% of the credits in this deal.
Yeah, but
you're all fungible after that.
The recapture risk. Let's say I sell Jesse takes the prime credit and Karen, you take the bonus. If we just sort of think about it that way, but then there's a recapture. You'd like it to be okay. Well, if there's a recapture because the domestic content didn't actually come through, and you didn't get that 10% credit, that only affects you, Karen, because that was only your piece of it. But that's just not the way it would work.
Right.
Although I did notice, I don't know whether it's been resolved by Treasury, but I thought I saw comments that were filed with Treasury asking for them to reconsider the bundling of the bonus credits with the main credit, because it limited the type of market that might be available for some.
Yeah.
Although you can see,
we're still dealing with proposed regs, right? There's still I think a decent chance that some of the stuff we're talking about in terms of how this will all work that was dealt with in the regs might change when we get final regs. And don't ask me when we're going to get final regs, please, because everybody asked me that and I have no idea.
We have a couple of questions. Let's see if we can get them in. From a buyer perspective, does the risk of transferability change when the transfer is made from a partnership flip structure versus someone who simply enters into a transfer transaction directly, between where the sponsors the transfer and they go directly to a transferee? Any perspective on that, Karen?
It does. It does for one main reason, and that is that the IRS left vague what is the acceptable basis for the credits. They said based on reasonable evidence that the basis is correct. You increase the reasonable evidence exponentially if it's passed through a holdco partnership first, where all the parties involved in that have done their diligence on it. If it's direct, maybe you have an appraisal and a cost seg from a reputable party, but it hasn't changed hands in an arm's length transaction. So I think that that is the real place where direct versus through a financed transaction makes a difference.
Or really the consensus in the market that we've seen is that if you are doing a direct transfer deal sale from the sponsor, you should be claiming your credit on cost. You should not be claiming it on fair market value because you have not done that third party arm's length sale.
Right.
So that way you're at lower risk as a buyer.
Correct. So you likely would still need a cost seg. You would still need a cost seg, but not the appraisal.
Yeah, you'd run no risk that appraisal would be challenged. Right.
And again, that favors large deals where the build cost isn't that different than the income approach to valuation.
The other risk of purchasing a credit directly from direct transferability, no structuring involved, is that the buyer of the credit has to ensure that the sponsor understands they cannot disrupt the equity ownership structure of that project all the way up to the corporate taxpayer for 5 years. So Chris and Meryl, curious if you guys have thoughts on blocker entities and other ways to create some buffer there. But I think it's unreasonable to expect that a sponsor wouldn't, recapitalize or change their capital structure for 5 years.
Yeah, definitely risks in that regard. And, tax exempt use property rules don't go away in that structure. So that's always a concern. There's a lot of reasons why transferability is not as simple as people want it to be, because that recapture risk is still out there, even if it is reduced.
And I think we'll get there. It's just new. And for folks like us, we're used to thinking about these deals in terms of a partnership with certain safe harbors and certain, well-trodden pathways. And we're going a little bit off the path now.
Yeah, I was talking to Mitt Buchanan at JP. She likes to call transfers diligence light, which I think is an apt description. But you still have to know, do you have site control for at least the period of 5 years? Is your offtake going to keep this a viable going concern project for at least 5 years? Do you have title to the land? There are some things like that you just can't get away with not doing. I mean, you can if you want to take the risk, but those are pretty risky things that we recommend you not go around.
You're just saying that because people may do less diligent, those are the same risks, whether you're doing a partnership flip or a transferability transaction. One of the questions we have is, how do you see transferability transactions working with smaller CNI solar projects? We touched on that earlier. It's a smaller market, perhaps higher priced.
Yeah, maybe you'll find some small insurance companies or small regional banks who would undertake a transfer for like $15 million in credits on a CNI deal. I have not gotten interest from any of those players on that. The way it could work is if you have a portfolio that you put together over a year that totals up to maybe 75 million in credits. And then once you see how many of them actually place in service, you've registered them as being available for transfers, whatever amount of it places in service, then you get a registration number from the IRS, then you might be able to sell it. But I think those would be much easier to take through a financed syndicated platform than direct from sponsor.
Got it. Thank you.
Small
I see it working just
projects. There will be a market here. I think it's where there are credit transfer platforms that are popping up all over the place. Many of them are specifically addressing the smaller CNI space. They can help with diligence, they can do an aggregate ITC policy, so on and so forth. But we're also seeing, Karen, just anecdotally, some interest. There are corporates of all sizes, right? So there are corporates out there who just want to buy 10 million in credits. They may end up going through these credit transfer platforms just for efficiency's sake. But that's not to say that a small CNI developer couldn't find a corporate like that to do a bilateral deal.
Well, you can send them to me. Send them to me, Jesse. I'll help them.
Okay. Well, listen.
And I think some of the smaller developers, who are doing 1 megawatt projects, et cetera. I think in a lot of ways that's tax equity in that world is a relationship business. If you're working with a bank that you have a relationship and they've been lending you, $1 million, $2 million a pop for your projects, there's a decent chance banks like that, those regional community banks, want the credits as well, but don't want to deal with the entire tax equity world. And so
Yeah.
you could see $500,000 of credits, $1 million of credits transferring on those transactions, I think, pretty easily.
Yeah, and we work with a lot of those banks, but you know why they don't want to do transfer credits? Because they like those returns. They like cash, they like losses, they like returns. But maybe it could happen.
Yeah, well, listen, we're just about out of time, or we are out of time. So, and we could keep going for a long time, but we're ending on some pretty positive notes in terms of where we think the market's going, and developments, portals, and opportunities for everyone as the market becomes more knowledgeable and sophisticated. I want to thank you all for joining the Pierce Atwood webinar on Inflation Reduction Act 1 year later. I particularly want to thank our panelists, Chris Emick, and our guest, Karen Berry from NT Solar, Jesse Robbins from Generate Capital. Thank you so much. It's been a terrific discussion. For those of you who did not get your questions answered, we'll try and follow up with you, or please feel free to email them to any of the panelists, or if you haven't put them in there, if you have any other follow-up questions. Thank you so much. Enjoy the rest of your day. This is Merrill Kramer from Pierce Atwood. Talk to you soon. Thank you. Bye-bye.